We have a lot to get to when it comes to the overall stock market. Now, last week alone, we've seen a huge escalation of conflicts around the world, and we've seen a lot of volatility. So I want to talk a little bit about that and how that's going to relate to your overall wealth plan, your portfolio, and then the strategies going forward. So that is what we are going to be covering today. And then we're going to wrap up with what we call the second opinion service. We have a lot to get to, and we're going to dive right in. Let's start with number one, economic and stock market risks. Last week, we had an incredible amount of conflict between Israel and Iran. And we've had some retaliation that is starting to happen. So what this is doing is starting to increase volatility of the stock market. And when we see that, the oil market really starts to spike higher. Now, we have not seen that though. We've seen some resilience, and instead, the price of oil, with Brent oil being around $85 to $90 a barrel, this is actually signifying, well, stability, which is not what we were expecting. And with all the turmoil, with all of these things that are happening around the Middle East, oil should be spiking a lot higher. And what this is actually saying then is maybe there's actually cause for optimism that the retaliations are not going to be taking place into the future, and that neither side wants to escalate. Now, yes, that could be just a head fake and may actually start to happen where we see some escalation. But right now, oil actually is one of those key elements that sniff out some of this conflict. And if we see conflict starting to rise, you would start to see the global oil supply start to go down, which would drive prices higher. Now, like I said, that's not what we're seeing. And in fact, the oil market is starting to soften just slightly. But what I'm saying is that this is usually a first indicator for all of these regional tensions. And if it starts to spike higher, that could mean a lot more to come. But here's the other element. It's not just the Middle East conflicts, especially between Israel and Iran, that are really causing havoc. The one that is actually causing more hurt and pain right now are bond yields and inflation. You see, what happens here is that bonds themselves are starting to sell off because the bond yield, which what we call is negatively correlated. So all that means is that if the bond price goes down, the yields go higher. Right now they're above 4.5% on the 10-year yield. And this is, again, a huge change just because of inflation. So when we really start to see this, generally speaking, let's go back to Israel and Iran, you would actually see the opposite happen. That when we see tensions start to pick up, you see bonds start to pick up in price and the yields start to go down. Again, we're not seeing that, which is actually another reason to believe that maybe the escalation is not happening the way that we feared, which would be an incredibly good thing for not only the world, but also for those that are involved in the kind of horrific nature of some of these wars. But the other thing, though, that I wanted to just really remind you of is that inflation is here and it's kind of pervasive right now. And that is why we're really starting to see the yields spike. And that's what we really want to closely monitor right now. Because if we see, and again, this is conjecture at this point in time, it could very well happen or it may not, but there is likelihood that we could see a huge spike in yield prices, even up to 6.5%, so well over 2% higher from today. And that would play havoc to the entirety of the bond market and the entirety of the stock market. So there's some negatives out there, yes, but there's also some positives, and I want to highlight that next. Section 2, portfolio changes. We actually have a lot of changes that we've been making over the last week, especially with some of these, well, instabilities and volatility of the stock market. Now, one of the things that we're looking at here is with all the kind of turbulence that's out there, that we're starting to see, again, inflation creep up, which would signify a bad place for small and mid-sized companies. You see, what happens is that those companies are going to get hurt really first when it comes to higher borrowing costs to not only pay for bills, but also to buy supplies and manufacturing goods that they need. And if that's the case, we do not want to own small and mid-sized companies. We want to move higher into larger companies. But then what ends up happening is that with the increasing amount of volatility, we actually want to put more liquidity and cash alternatives into the portfolio as well. So yes, we've reduced some of the exposure to the stock market and the bond market, and we're holding a higher level of cash and money market alternatives as well. And that's providing a little bit of a safeguard, because right now, bonds are not the safe haven they used to be. But when we also look at things like commodities, we're starting to see changes happening with them, and those are really starting to be great places to be invested. Base metals and many other elements like copper are already starting to go higher. Now here's the thing, copper is very interesting because if we are in a state of our economy and the world economy that is going to be very affected by, well, pain of the Middle East, and for low or no growth at all for the economies, then we should see copper starting to go down, not up. This leads us to really say that yes, our call for this year, really for a global lead too, where we see growth and inflation happening, is actually on track. But there could be some local elements here in the US that we tip into a lead 3 status where we don't see any growth, or even worse, where we don't have any growth and any inflation as lead 4. Now, yes, that can happen, and that does happen from time to time. Right now, we are witnessing one of those times here in the month of April, but going forward, we are definitely seeing mathematically that will change, and we can be changing with that as well. Now, what should be working in this environment is real estate, especially with real estate investment trusts in your portfolios. But when we see inflation spike higher significantly like this, that's where even real estate is not exactly the best place to be invested, just because of the sensitivity to interest rates. So there are changes to be made today, and there are ones to be made going forward. But all of these are designed to not only protect where we're at today, but also to start to build for what's to come in the future. Section 3, wealth management and advanced planning. I want to dive into a couple sophisticated strategies. You see, when we take a look at your income, there may be reasons why you don't want that income, and we want to shift that to other entities or to your children. That's what we talk about when we are looking at income shifting planning. Now, what this is taking a couple different elements, and we're going to take a look at 2 today. One that we've talked about in the past, the charitable remainder trust, as well as a new one, the family limited partnership. Now these are, well, can be expensive and costly to implement, which means they're not for everyone. But if we need to shift income and assets from yourself to, say, either family members or other entities to reduce your overall not only tax burdens, but also estate, this is a great way to do that. You see, when we take a look at the charitable remainder trust, what this will do is allow you to receive the income for a set number of years or even sometimes your life, but the remaining of the assets go to a charity of your choice. And what that will do is actually limit, say, highly appreciated assets from being sold in your tax bracket, but you can use them, still collect the income, and not have to pay the tax, and possibly even get a tax break from the charitable donation as well. So there's a lot to be said about that with the income streams and the ways that it can work. Now the family limited partnership is, well, similar but slightly different. See, what happens here is that you can transfer your assets to your family members while you retain the control and the management of those assets. So this is actually a really good way to reduce your overall estate taxes, protect the assets against creditors, and draw in the other family members for helping with them as well. So that's just a glimpse of some of the different elements of the planning here. But if you need help with working on how to shift your income, you may want to consider one of those possibilities. Number 4, our second opinion service. As a firm, we understand the importance and the confidence of your financial strategy, which is why we are offering a comprehensive second opinion service. Now, what this is a way for you or some of the friends, family, and people that you care about to really have a stress test of your overall wealth plan and go through the process to identify where you're at today, where gaps may exist, and to see and to learn about ways to correct those gaps. Now, this is a huge element that really comes back down to knowing exactly where you want to go and then all the different details there that we can help identify and provide some ideas on how to correct. So as you want to be going through a second opinion service, which will be complimentary for watching this video with the link below, then you can actually have the foresight to know of changes that are needed and ways that you can be helping to improve your overall wealth plan in the future. We did cover a lot, and if you have any questions about what we've covered, please feel free to reach out.